Canada's big six banks wrapped up a solid quarter of earnings this month, reporting good year-over-year growth, but the outlook for all the banks has been thrown into chaos with the uncertainty surrounding the outbreak of COVID-19 that prompted rate cuts both from the U.S. Federal Reserve and the Bank of Canada. I sat down with Mario Mendonca. He is managing director at TD Securities for a look at what to expect from the banks in this new environment. Mario, I want to start with, I think, the title of your note that just came out. You talk about it being a solid quarter for the banks, but we're back to talking about aggressive rate cuts. How difficult is it right now? I mean, if we just review, banks reported literally on one of the last days, everything blew up, and so everything comes into question, I'm assuming. So we'll get to how the banks did, but I want to talk to you about how difficult is it right now to figure out what's happening and what's material and what's not.
Yeah, I was definitely thrown a curveball this quarter. Going into the quarter, I felt that strong capital markets numbers and even a more positive outlook on margins might set up the banks for a better 2020, but of course everything blew up around that time. Now we're thinking about what will rates be doing over the next little while and how will that affect bank margins. When the Fed cut rates by 50 basis points and Canada followed by another 50, that immediately affects how I look at banks. And it's especially important to banks with large U.S. operations like Bank of Montreal. It's had the effect of I've had to take my earnings estimates down by as much as 3% for Bank of Montreal because of the size of their U.S. business. But it's had similar effects for the other banks, more in the 1 to 2% range. And that's relevant to me because the banks were never expected to grow earnings very much this year anyway. Mm-hmm. So if you were only expecting, say, 4 or 5% earnings growth and you're taking 2 or 3% off of that, you suddenly find yourself with very modest earnings growth across the group.
The one thing that you talked about in your note as well, too, is, I mean, you had taken down your earnings growth and then you took it down again because of the rate cuts. What about future rate cuts, though? Yeah. I mean, because that's the one thing that I think into these numbers you baked in what had just happened.
Right. I baked in also what TD Economics has us planned for in the future. At this environment, because it is so fluid, it's one of those times in my career when I find myself the least confident in my numbers. And that means something because if I'm not confident in my numbers because it's changing so much, investors aren't confident. And that's why we're seeing some of the moves we're seeing in the markets today.
Let me ask you, you were mentioning before we started here too, is it part of the issues with everything that's going on is it doesn't just affect interest rates. I mean, that it affects everything from the business and commercial. It just affects everything.
Right.
So can you just kind of walk us
Sure.
through where you see things being affected right now?
Very often I'll go back to first principles and I'll say, what are all the pieces of these banks that are being affected? And it's fair to say, I'll occasionally refer to these banks as evergreens. They're good for any season. But right now, everything's kind of gone wrong at the same time. Not only would you see margins come down because rates are going lower, but loan growth is slowing. Loan growth will slow if economic growth slows. Capital markets revenues slow. If credit spreads move higher, which they have, that could hurt your capital markets revenue. The markets are down. That'll hurt your wealth management revenue. Economic growth could cause higher credit losses. So you can see that this environment seems to touch everything. It touches every part of the model, and it's for that reason where I become a little less confident in my numbers. I think it's fair to say that at no point am I concerned about the capital strength of the banks. I always come to that at some point. But certainly the earnings growth, I have less confidence now than I have in some time.
Let me ask you, though, because I think the one thing is, I mean, it's your job to build scenarios and take a look at all the different things that could happen. But, a lot of people also saying that, when 2008 happened, it was a systemic crisis. Mm-hmm. And this is a public health crisis, I would say, but something one hopes that will flip the other side and there'll be a fairly rapid recovery as there was a done. So do you think that is something that's baked in right now, too?
The market is not pricing in the recovery. It doesn't feel like that to me when you see the sorts of days we've seen. I think this one is particularly challenging for capital markets because we're not used to it. I'm not accustomed to, how do you deal with something like this? How quickly will this spread? What effect will this have on supply chains? I don't think we're equipped to measure it the way we could a financial crisis. And in a financial crisis, flushing the world with liquidity had the effect of getting people to borrow and lend again. I'm not sure how that works in this environment. I'm not sure that cutting rates to near zero is going to have the desired effect. In fact, the day the Fed cut by 50, there was a slight upward move in the market followed by a crash immediately after. And I think that was so reflective of the market suggesting that was a 50 basis point cut even necessary, and will it have the desired effect? And that's why I find this one more challenging, in fact, than perhaps 2008.
Yeah, some of the critiques have been, of course, is that you're going to have a longer-term impact of the rate cuts, even when the health side hopefully bounces back. Okay, so I want to, as promised, go back to a bit of the beginning, because part of, I would say, is how everybody fares in something like this is how strong they are going in. So if we take a look at the earnings that did come out in the first quarter, again, previous to when this happened, but the earnings number was actually pretty good.
They were good, yeah. And let's examine what made the quarter look good. The first thing I'd highlight is that the capital markets numbers were great. Our Canadian banks grew revenue by about 7%. Most of that revenue growth came from capital markets. So trading revenue, for example, is up 39% year over year. Underwriting and advisory is up 53% year over year. So the revenue environment was good. On top of that, credit losses were only up 7% year over year across the big banks. And that's very important for me, because what it showed was that, sure, there's a normalization in credit, but we're not seeing any major material deterioration. Delinquencies moved slightly higher on credit cards. Some commercial loan losses started to appear. But I'd say, on balance, I felt pretty good about this quarter. Of course, that was all destroyed by the market reaction to the COVID.
And you also, of course, I mean, you talked about capital and trading revenue. We did see some nice performance there. Yeah. And also the net interest margin guidance was improving, but again, that kind of has a big X beside it now.
It did. I had a strong feeling going into the quarter that we'd be talking positively about the margin. By the end of that quarter, we were completely talking about the negative.
We are, though, I would say, too, and I think it's important that, you had a strong quarter, but again, you were seeing, though, I'd say overall, like earnings growth was coming down, though, kind of looking into this year and next year. So it was slowing.
Sure.
It just it didn't come to a screeching halt like it did, right?
That's exactly what happened. And in fact, when you're slowing and then you add another layer of stress, as we're seeing now, with margins and potentially credit losses, could we come to a period where earnings growth kind of goes to zero? It's conceivable. These are incredibly resilient institutions. I think that's important to say. And capital, for me, is not in question. When I say capital, I mean the strength of the institution is not in play. But what I would suggest is it's conceivable we could have periods where several of these banks simply don't grow earnings over the next little while. And that's meaningful for a guy like me, because I'm used to, over the last 20 years, watching these banks grow earnings on average 7-8%. So it's a meaningful change for me.
And these banks, of course, earn their valuations by being consistent and always delivering those things.
And earnings growth, of course, drives your dividend growth, and dividend growth matters to retail investors, or matters to everyone, but particularly retail investors. And if earnings growth slows to zero, do you find yourself finding perhaps you won't be growing your dividends for a little while? I don't expect any dividend cuts, I'll be very clear on that. But could you see a period where dividend growth becomes anemic? Sure.
Let me ask you about names, because obviously you've got ratings, and we never talk about TD for obvious reasons. Mm-hmm. But if we run through, your ratings on them in terms of BMO, you've got a hold, 99 price target. Bank of Nova Scotia hold 75, CIBC hold 110, National hold 67, and Royal a buy, the lone buy in the group at 115.
So it was early in 2019 when I started to get a little anxious about bank stocks. I started building in lower earnings growth. And I took this approach. I said, I don't want to have a buy on any of these Canadian banks, but maybe one. I said, look, what is that one bank that I'll have a buy on? And I selected Royal. And that's my way of saying I'm very cautious on these banks, but if I'm going to have a buy, it's going to be on the one I perceive to be the highest quality.
And you did this before COVID, I have to highlight.
Oh yeah, it was in 19,
exactly.
Early 19, about March 19, when I said, boy, I want to be conservative here. So I got really conservative on on the group, and I made Royal the buy. It's been a good thing to do. Not that Royal's had great performance, but at least it hasn't had really bad performance relative to some of the others. And Royal, I sort of see it as that high quality name. They have a very strong domestic retail franchise, strong wealth, strong capital markets, a business in the US that's growing, a very strong capital ratio, and a management team that I like and I trust. And I kind of, if I'm going to be somewhere, it's going to be in Royal. Mm-hmm. But beyond Royal, if you're willing to look outside of the Canadian banks, there are some names that provide you pretty good shelter right now. Take an Intact, for example, IFC. Intact doesn't have equity market risk or credit risk to speak of, or interest rate risk. It has all of these risks, but at a very attenuated level. It's one of the reasons why the stock is trading at an all-time high as well. But that's a company that I like right now because it doesn't exhibit the sort of risks that I'm concerned about.
Right, but to your point, it's that's all that's priced in because it's safe.
100%.
Or perceived safe, I will say.
Perceived safe. And let's be clear, it is trading at an all-time high. In this environment, for a stock to be trading at an all-time high, yes, of course, people have recognized this.
Yeah.